Whole life insurance, or whole-of-life assurance, is a life insurance policy that remains in force for the insured's whole life and requires premiums to be paid every year into the policy. Non-participating, all values related to the policy are usually determined at policy issue, for the life of the contract, and usually cannot be altered after issue. This means that the insurance company assumes all risk of future performance versus the actuary's estimates. If future claims are underestimated, the insurance company makes up the difference. On the other hand, if the actuary's estimates on future death claims are high, the insurance company will retain the difference. Participating, in a participating policy, the insurance company shares the excess profits with the policyholder. Typically these refunds are not taxable because they are considered an overcharge of premium. The greater the overcharge by the company, the greater the refund dividend. For a mutual life insurance company, participation also implies a degree of ownership of the mutuality. Indeterminate premium, similar to non-participating, except that the premium may vary year to year. However, the premium will never exceed the maximum premium guaranteed in the policy. Economic, a blending of participating and term life insurance, wherein a part of the dividends is used to purchase additional term insurance. This can generally yield a higher death benefit, at a cost to long-term cash value. In some policy years the dividends may be below projections, causing the death benefit in those years to decrease. Limited pay, similar to a participating policy, but instead of paying annual premiums for life, they are only due for a certain number of years, such as 20. The policy may also be set up to be fully paid up at a certain age, such as 65 or 80. The policy itself continues for the life of the insured. These policies would typically cost more upfront, since the insurance company needs to build up sufficient cash value within the policy during the payment years to fund the policy for the remainder of the insured's life. Single premium, a form of limited pay, where the pay period is a single large payment upfront. These policies typically have fees during early policy years should the policyholder cash it in. Interest sensitive, this type is fairly new, and is also known as either excess interest or current assumption whole life. The policies are a mixture of traditional whole life and universal life. Instead of using dividends to augment guaranteed cash value accumulation, the interest on the policy's cash value varies with current market conditions. Like whole life, death benefit remains constant for life. Like universal life, the premium payment might vary, but not above the maximum premium guaranteed within the policy. Requirements: whole life insurance typically requires that the owner pay premiums for the life of the policy. There are some arrangements that let the policy be paid up, which means that no further payments are ever required, in as few as 5 years, or with even a single large premium. Typically if the paid doesn't make a large premium payment at the outset of the life insurance contract, then he is not allowed to begin making them later in the contract life. However, some whole life contracts offer a rider to the policy which allows for a one-time, or occasional, large additional premium payment to be made as long as a minimal extra payment is made on a regular schedule. In contrast, universal life insurance generally allows more flexibility in premium payment. Guarantees: the company generally will guarantee that the policy's cash values will increase regardless of the performance of the company or its experience with death claims. The dividends can be taken in one of 3 ways. The policy owner can be given a check from the insurance company for the dividends can be used to reduce the premium payment, or the dividends can be reinvested back into the policy to increase the death benefit and the cash value at a faster rate. When the dividends paid on a whole life policy are chosen by the policy owner to be reinvested back into the policy, the cash value can increase at a rather substantial rate depending on the performance of the company. The cash value will grow tax-deferred with compounding interest. Most whole life policies can be surrendered at any time for the cash value amount, and income taxes will usually only be placed on the gains of the cash account that exceeds the total premium outlay. Thus, many are using whole life insurance policies as a retirement funding vehicle rather than for risk management. Liquidity: cash values are considered liquid enough to be used for investment capital, but only if the owner is financially healthy enough to continue making premium payments. Cash value access is tax-free up to the point of total premiums paid, and the rest may be accessed tax-free in the form of policy loans. If the policy lapses, taxes would be due on outstanding loans. If the insured dies, death benefit is reduced by the amount of any outstanding loan balance. Internal rates of return for participating policies may be much worse than universal life and interest-sensitive whole life because their cash values are invested in the life insurance company and its general account, which may be in real estate and the stock market. However, universal life policies run a much greater risk, and are actually designed to lapse. Variable universal life insurance may outperform whole life because the owner can direct investments in sub-accounts that may do better. If an owner desires a conservative position for his cash values, par whole life is indicated. Cash values associated with these policies carry provisions alongside their benefits that may not be beneficial for policy owners and insured individuals. Typically, when death benefit is paid out, policy cash values revert to the issuing company. They are therefore lost. The reason for this is that all policy cash values become owned by the issuing company, they therefore control when and how these are paid out. See also, life insurance, permanent life insurance, theory of decreasing responsibility, buy term and invest the difference, references, Alexander B. Granis, Chair. The Feelings Not Mutual. New York State Assembly. Retrieved January 15, 2007. A Guide to Life Insurance. The Association of British Insurers. Archived from the original on December 10, 2006. Retrieved January 16, 2007. Glossary. Life and Health Insurance Foundation for Education. Retrieved January 15, 2007. Florida Life and Health Study Manual, 12 edition, Whole Life Insurance. The Asset Protection Book. Archived from the original on January 14, 2007. Retrieved January 17, 2007. External links, chart comparing different types of life insurance, learn about life insurance. Insurance Information Institute Life Insurance Learning Center, the Life and Health Insurance Foundation for Education. A History of Life Insurance in the United States through World War I. Illinois Department of Financial and Professional Regulation, Division of Insurance, Slavery-Era Policies Report August 2004, Code of Ethics, National Association of Insurance and Financial Advisors.